Because folks,
Strongman Personal Finance.
ain't no dang jokers.
Alrighty, folks, big video. So in this video, I want to address the last time I was ever bullied in life. Hey there, folks!
You're spending more of our money on those stocks. I'm gonna beat your ass. I'm gonna beat your ass.
Boy, did I get brutalized today.
Welcome back to Strongman Personal Finance, everybody. I'm actually really freaking tired, but somebody requested that I do this analysis of a stock, and this is an accounting analysis. I'm not going to project future cash flows because I don't know the future. But we're going to talk about this real estate property management software as a service company that's based in the cloud, AppFolio. And we're going to determine if this is a 10x stock by looking at past transactions that have been compiled into financial statements. Welcome back, everybody. My name is Christopher Belli. I'm a certified CPA accountant. I'm a fake boglehead investor. I'm author of the book, Stop Being a Broke Loser. It's on Amazon. And let's go dive right into it. And like I said, I'm freaking, I don't know what happened. It's just like a wave of exhaustion just hit me. I'm freaking tired, okay? Probably that awesome workout I did today. So what is AppFolio? Well, very simply, it's cloud-based software as a service, property management software. If you are a property manager and you have a bunch of clients, you have a bunch of tenants and, units, and you want to have a all-in-one system that helps you manage your clients, manage the properties that you're managing, this is something you could potentially look into. And the beauty of it is it's cloud-based. What the cloud means, it's like Dropbox. You can, log on anywhere and access the software by logging into the cloud. You can go to Djibouti, as long as there's an internet connection, and you can access your software and you can manage property. You can work from anywhere. And you can see some of the stuff they do. You send out K1s, that's a tax form, track signatures, promote new offerings, send payments. Basically anything when you imagine a property, like what a property manager does, they got to get repairs out there. They got to bill tenants. They got to, collect rental income. They have to track all the money. All of that gets done with AppFolio. Now, we want to look at the financials of this company because that's what matters. So, like I said, I pulled up the business here. I've already talked briefly about the business. We're going to go ahead and look at the financials because if you want to invest in a stock like this, or if you want to potentially use the software of the company and you're worried about the financials of the company, this is something to look into. Now, we'll start at the balance sheet. Balance sheet. We'll go full screen here. And I'm going to give you my opinion of the balance sheet as of June 30th, 2022. So some things I look for right off the bat are, is the company able to pay its short-term debts? To determine that, you want to look at, let me make sure I'm sharing my screen. I always get paranoid. I'm not doing that. I'm tired, everybody. If you don't like the video, you can click away. There we go. I am sharing my screen. Okay. You can always look, if you want to see if a company can pay its short-term bills, you can look at its current assets, which is right here. And that consists of cash equivalents, investments, accounts receivable, prepaids, stuff that'll be converted to cash within a year. And you compare that to short-term debts. Now, for AppFolio, we can see they have $156 million of current assets, short-term assets, on their balance sheet as of June 30th, 2022. How much that has changed in the past couple of months? I don't know. This is the information I have. We compare that to current liabilities. These are debts that are due within a year. Current liabilities are only a fraction. They are $54 million. So their current assets are 3 times as great as the current liabilities. Now, if you want to be more stringent in this test, when you think about certain current assets, like a prepaid, let's say you prepay insurance. You, instead of paying every month, you decide to pay the entire insurance bill up front for 12 months. Well, that's a prepaid. It's not as liquid as something like cash and cash equivalents, cash itself, an investment security that you can sell on the market and then utilizing cash once it settles. There are things that are more liquid than others. Now, you can just look at cash and compare that to current liabilities. which in that case, they wouldn't be able to pay their bills. But they also have $75 million in investment securities. And those securities are, and I looked in the notes, mostly treasuries, agency bonds, and a little bit of corporate debt. So overall, when I'm looking at this, I see a lot of liquidity. I don't think, unless something crazy comes out of left field, I don't think AppFolio is going to go bankrupt within a year. Anything could happen, but just looking at it, that's the case. Next, I like to look at long-term assets. Your long-term assets are assets that you can use for more, you're going to use for more than a year. Property, plant and equipment, leases, intangible assets, goodwill. All things that you use for more than a year are long-term assets. And what I like to do is compare that to long-term debts. So we can see their long-term assets. And they actually don't break it out, which is kind of annoying. Their long-term assets, or if they do, I'm too tired to see it, are $219 million, of which $56 million is goodwill. So their tangible long-term assets are really $162 million. Now, what I like to do is compare the long-term assets to long-term debt. And the reason I like to do that is I want to say, okay, how much of these assets do they own free and clear of obligations? And always remember, when it comes to accounting, the number that you see, let's say you're looking at property, plant, and equipment on a balance sheet. The number that you see is the cost of all of those property, plants, equipments that were bought, net of depreciation. So if you, let's say you buy a house, right? And it's on a balance sheet. If you pay $150,000 for that house is on your balance sheet for $150,000, and you depreciate it, and that number on your balance sheet goes down and down and down and down. And that house could be worth double that on the market, triple that on the market, but that's not going to show on the balance sheet. So while you can use a metric like book value to, kind of factor into a valuation, I think fair value is a much better way to value the assets of a company, assets and liabilities. The issue with that is, how do you know what the fair value is? I mean, good luck finding the fair value of a company's property, plant, and equipment, right of lease, lease assets, and intangible assets, yada, yada, yada. Good luck with that. Anyway, back to the analysis. So they have $162 million of long-term assets, and they have roughly $50 million of long-term liabilities. So looking at that, I don't see any major balance sheet issues with this company. Anything could happen, but if you're worried it's going to go bankrupt within a year, at least as of June 30th, 2022, they're sitting pretty freaking good. Okay. So I don't think they're going to go bankrupt. However, in the near term, there is a problem with the profits of this company. And I actually had to do some vertical analysis. So what I did, and you can do this yourself if you want, is sometimes it's hard to tell why a company, it went from being profitable to being unprofitable. And we can see here for the 3 months ended June 30th, comparing 2022 to 2021, just 3 months, the company went from being profitable to pretty freaking unprofitable. Okay. As a matter of fact, in the 3 months ended June 30th, 2022, they lost, or their profit margin was, right, 70 divided by 117, negative 25%. So they've gone from slightly profitable to now pretty unprofitable, which is not good. You want to have a profitable company. But you're looking at this, you're comparing these two numbers, or you're looking at earnings per share, and you're like, okay, why did earnings per share go from 6 cents positive to 86 cents negative? Well, you can use vertical analysis to help you figure out what costs are exploding. So what I did was I got the 3 months ended June 30th, 2022 here. So I have 2022 and I have 2021. I'm comparing the years. And I took a percentage and I took each cost on the income statement and divided it by the revenue to see what percentage of the revenues are being used for selling and marketing, R&D, general administrative expenses, depreciation, yada, yada, yada. And we could see, you look here, if the numbers are higher, we're comparing this to this. This is 2021. This is 2022. If the percentages are going up, that means that that expense item as a percentage of revenue is going up. So they're having a harder time controlling costs. Probably has something to do with inflation. Okay. But look at this. So cost of revenue, cost of goods sold has gone up 4% as a percentage of revenues. Sales and marketing up roughly 3% as a percentage of revenues. R&D 5%. General and administrative. That's a big warning sign right there. General and administrative expenses have gone up by 32%, or sorry, 15% as a percentage of revenues. So they spent 32% of their revenues on general and admin expenses. Why? I mean, we can look into it a little bit more. Let's see if there's actually a note in here. There is a note, it looks like. Or maybe it's referencing, whatchamacallit. Because usually what happens is when you're looking at financial statements, you got to look at the notes to get more detail. Administrative. See if I can actually find it here. Okay. During the second quarter of 2022, we decided to exit and make available for sublease certain lease offices. So they did some reassessments of fair value. We recorded an impairment of $19.4 million. So that impairment, they had to do a write down. So they reassessed the value of some, leases, some assets. And what they did was they had an impairment charge. So a one-time charge that massively increased general and administrative expenses. But would you have known to look at that without first doing a little simple vertical analysis? Probably not. But by simply doing this, you can see, wow, general and admin was only 15% of revenues in 2021 for those 3 months. And now they're 32%. Something ain't right there. Okay. So even though this is probably a one-time charge, it seems like costs are going up across the board. You can see the percentages are going up. And what that did was that led to a loss from operations. And even if you got rid of that impairment charge, you would still have a loss on the for operating income. So this company is starting to get into trouble a little bit. They're having trouble controlling costs. Now, we can see how it's going to pan out. But like I said, I don't think this company is going to go bankrupt within a year. But if you want to use this software, just kind of keep in mind, if you're worried about this company going under, just keep track of the financials every quarter and see if they start to get a grip on these costs as a percentage of revenues that continue to go up. So we can go look at the statement of cash flows. And what this does is it shows you how the cash changed. So while they had a massive loss, and this is for 6 months ended June 30th. You always want to check this to make sure you know what you're looking at. Sometimes there's 3 months, sometimes there's 6 months. Here, over 6 months for 2022, they still had a little bit of positive operating cash flow. So they're still generating positive cash flow from their business. However, that's down pretty significantly from 2021. And I'm sure the real estate market, if this is interconnected to the real estate market, remember, this is real estate software as a service, cloud-based, whatever. And so it's probably going to be impacted by, changes in the real estate market. Now, if we go look at the investing activities, let's see what they're doing for investing. So they're purchasing available for sale investments. That's like a middle ground between trading securities and what's the freaking term for it? Whatever, like long-term investments. They sold some securities. They bought a little bit of property, plant, and equipment, and they spent some money on software development. So nothing crazy here on the statement of cash flows for investing. I mean, most of the cash flows from investing are them just parking money into short-term investments. And they're at least on the surface, they look safe, like treasuries or agency bonds. I wouldn't be too worried about those. And financing activity. So a little bit of money that came in from exercising stock options, and looks like tax withholding for net share settlement. I'm not sure exactly what that is, but it's not a huge chunk of money. I've never seen that on a statement of cash flows. So at the end of the day, they overall burned cash. Their cash balance went down from quarter or over the 6 months. But most of that, a big chunk of that, was because they're just parking the money into investments. So it's not a huge warning sign. But if you're looking at using this software, you want to track it if you're that worried about it to see what's going on. Okay. So overall, I mean, this is a legitimate business. It looks like it's pretty convenient. You know, if you're a property manager and you want to put everything in one, you can do that. Okay. And it's great. It's like this one-stop shop that's based on the cloud. But, if you're worried about the financial health of the company in the short term, I think it's fine, at least from a balance sheet perspective. From a cash flow perspective, it's degrading because their operating cash flow is decreased. And they have had pretty significant cost explosions on their income statement, which is concerning, probably because of inflation. Okay. And they also had that one-time impairment on, whatever that asset was. So that's basically what I think about the company. I mean, we can look at we can look at some other metrics real quick. So we can see they've had pretty solid revenue growth. Revenue's going up and up and up and up. We need to look at margins because margins matter. Share dilution, nothing insane. I mean, it doesn't seem that crazy to me. Earnings per share getting freaking wrecked. Number one, that impairment charge. And number two, they're having trouble controlling costs. Gross margin, it's gone down a little bit, but I mean, barely. It's basically around 60%. Operating margin, that ain't that great, okay? For 2019 and 2020, their operating margin, their profit from operations before interest and taxes was 2% and 3%. That's not a lot of room. And somehow they had a profit margin of 51%. That must have been some accounting adjustment in 2020. Okay. Free cash flow. They've generated free cash flow for the last 5 years, it looks like, but that's massively declined. And if we look at the quarterly, we'll see how they're doing quarterly. Okay. Let's see. Yep. Whatever's happening with these costs, they're really starting to hurt the company. You can see the decline. Their operating margin was 0, -7, -13, -25. Part of that's that impairment charge, but you can also see costs are exploding across the board from different sections of the operations. All the profit margins are getting worse, and now they have negative free cash flow. So from an investing standpoint, this isn't really my type of company. I mean, but I'm just looking at this from the perspective of somebody that's, potentially worried that this company could go out of business. I don't think in the near term with this kind of current ratio, and it's a solid current ratio, it ain't going to go out of business at least. But if we see in the future that operating cash flows start to be massively negative, then you might want to be concerned. But even then, it's like, okay, well, the company, even if they went out of business, I mean, they'll probably be acquired by somebody else. It seems like it's legit software. And companies can stay alive for a long time. As long as they can pay their bills, they could stay alive for a long time. Look at freaking Tattooed Chef. If Tattooed Chef hasn't gone bankrupt, I'm not worried about AppFolio going bankrupt. But I'm not telling you to buy the stock, and I'm not buying it personally. So that's my thoughts. All right. Strongman's eating his Tattooed Chef. Tattoo Mayato. By physical silver, ladies and gentlemen. I like how none of the comments are related to this stock. Kevin is parking the $14 million to buy tattooed to build Jeremy's homeless chef. This guy's a brain of a 3-year-old. These days, most of the grifters have switched from talking about growth stocks to high-paying dividend stocks. Well, they're just reading the news. And once stocks start going up again, buy. And I'll be here when that day happens. And you know what'll happen? Their channels will explode. They'll get rich. They'll get more subscribers. They'll get money flowing into their scammy courses. And I'll just be this broke loser in his garage. That weirdo Echoes bombed his Meat Breath interview. Or aren't you kind of a hater? I don't know. I didn't really have time to watch it. Tattooed Chef is below $6. It's actually a very good day. I'm really tired though. I don't know. I don't have time to crap on tattooed trucker sweaty putrescent shark covered nutsack tonight. Okay. Literally none of the comments are about the stock that I just talked about. All right. Well, that's it. I'll give you a LaFufu outro. Prepare your eardrums. 5, 4, 3, 2, 1.